Michael, it's good to see you. Tell us, first of all, where you're starting to pick up this trade down effect.
Well, we haven't seen a lot of it in the history yet. What we really wanted to understand was as consumers become more aware of these price increases and see them more broadly, how are they starting to react? How are they planning to react? Because it really feels like we could be close to a turning point here. And what they've said is that there's definitely trading down they plan on doing and cutting back as well.
So it's what you're really picking up on is the intention, the idea, and we've seen this in the saving rate, which is kind of captures that monthly income inflow versus expenditure, and that's moving back down towards zero. So it feels like other than the savings that they have in the bank, consumers are going to start to have to make tougher choices here.
That's exactly right. And we want to be as forward-looking as we can and try to understand how they may start making different decisions. And that's where within the group, we still have names we like. Hershey is one that we've very much we've got a belief in their pricing power. And in this survey, it looks like as a category, candy's faring quite well in terms of where consumers don't plan to make cuts or trade down. But then if you look at things like meat, half of the consumers that said they plan to cut back on a category cited that as their first primary place to go. And they've said it's a place where they plan to downtrade as well. We think that's where there's a good amount of risk.
Sure, and that's why Tyson is one of the names that you're downgrading to underweight here. Kellogg and Post present an interesting pair trade, if you want to call it, downgrading Kellogg, but saying that Post looks like it could be a winner. Why is that?
It's a difference in the composition of their cereal portfolios. Post has called out pressure on their portfolio in cereal over the last year and a half because they have a much more value brand skew, and they've seen some pressure as consumers have traded up, and we think that that's more likely to reverse. And then Kellogg is also in a particularly tough spot because they had a strike and a fire at one of their plants in the second half of last year that's really disrupted their ability to supply product and to run promotional prices and events. And so they already have share pressure they're under, and to try to restore that in an environment where consumers may have been away from your brands and are looking to trade down, I think puts them in a particularly tough spot.
Well, and a reminder that sector selection alone really may not save you right now. You got to get pretty stock-specific, pricing power-specific. Michael, thanks for joining us. We appreciate it.
Thank you.
Michael Lavery.